Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Wednesday, November 12th. The peak earnings reporting period for the third quarter is now over, as more than 80% of the companies in the S&P 500 have released their earnings results. The latest report from Thomson Reuters indicates that the blended growth rate, which also takes into account estimates for companies that have yet to report, stands at minus 13.9%. This is not an uplifting number, especially when one considers the estimate on July 1 called for actual growth of 12.6%. The financial sector, to no one's surprise, has been the scourge for the market in this reporting period. Its growth rate is negative 107%. Take the financial sector out of the picture, and the blended growth rate for the remaining 9 sectors is a respectable 10.3%. The energy sector, with earnings up 60%, has been the main offset. But if you took the energy sector out of the picture too, the growth rate for the remaining 8 sectors would fall to just negative 1%, according to Thomson Reuters. What this tells us is that the impact of the financial crisis was still largely confined to the financial sector during the third quarter. However, the guidance coming out of the third quarter reflects the spreading nature of this crisis. Thomson Reuters notes that there have been 73 negative pre-announcements for the fourth quarter from S&P 500 companies versus just 16 positive pre-announcements. The negative to positive ratio of 4.6 is well above the long-term average of 2.1. The Dow outlook has been a major weight on the indices, not to mention consumer and business sentiment. Strikingly, where the guidance does not seem to have weighed as much is on consensus earnings estimates for calendar year 2009. The latest estimate of $89.21 marks a 16% decline from where the estimate stood on September 5th. The bulk of the change, 11%, has come since the week ending October 10th. That makes sense given that the third quarter reporting period didn't begin until mid-October, yet it doesn't fit with a market that has declined 25% since the week ending September 5th. Accounting for the recent week's losses, the S&P is down 30% since September 5th as of this recording. The disconnect is rooted in the thinking that analysts are behind the curve with their earnings expectations for 2009. Accordingly, the market is pricing stocks lower on the belief that the path of least resistance for the consensus earnings estimate for calendar year 2009 remains to the downside. At current prices, the S&P trades at 9.9 times estimated 2009 earnings and sports an earnings yield, which is the inverse of the P/E ratio, of 10.1% versus the 10-year note yield of 3.69%. The disparity reflects the extreme risk aversion in the market, but nonetheless suggests stocks are significantly undervalued relative to bonds. There hasn't been a value stampede in the market, though, because the market is unwilling to accept the E part of the ratio as being credible, and the fear remains that estimates will come down further still as economic trends deteriorate in coming months. This concern is valid, but even if we allow for a 30% reduction to the current calendar 2009 estimate of $89.21, the corresponding P/E multiple would still be a reasonable 14.1 times earnings in an environment of disinflation, and the government seems to be doing all that it can to prevent deflation. The market's earnings yield, meanwhile, would be 7.1%. A valuation argument doesn't carry much sway in a trading environment like the one we are now in. Yet this goes to show plenty of air could still be let out of the official estimate balloon, and the market would still look reasonably priced for the long-term investor. The big catch is that investment-minded individuals need to be prepared to deal with continued volatility as the market reconciles whether it has adequately discounted the consensus estimate cuts that have yet to come. I'm Pat O'Hare for Briefing.com. Thanks for listening.